welcome to Asian Tigers, the series that we've been speaking to a lot of the big fund managers and the big strategists based out of Singapore and Hong Kong who keep an eye on the Indian market very closely. My guest on the show today is Sakthi Siva of Credit Suisse, who has been tracking India for several years now. Sakthi, good to see you.
Good morning.
And how have you read India's movements in 2013 so far? Because after such a good performance in 2012, it's been a bit of a wobble.
Yes, in fact, it's been rather disappointing. But I think a lot of that is also a little bit of profit-taking. Personally, my own strategy is to kind of buy the dips. So with this recent correction, we actually are highlighting that India is now one of the 4 cheapest markets in the region.
What do you think has caused it? Is it the fact that people just owned a lot of India going into 2013, or were there specific macro or earning triggers which might have caused it?
I think one concern that we've always had has been the fact that it is a very overbought market by foreign investors. Even if you look at this year, we've had about 13.5 billion going into emerging Asia, ex-China, but 8.5 has gone into India alone. So India, even this year, has gotten about 60% of all flows. So when you are already kind of quite crowded and you've had a 25% return just the last year, I guess it's always difficult for you to perform straight away. But having said that, as I said, with the dip, with India now joining the cheapest 4 markets, and on our models, this is the 15th time since 2000 that India has joined the cheapest 4. And if you look at the last 14 times, 13 of the 14 times, India has outperformed. So we're quite confident that India, by the end of the year, will actually be a major performer. We
haven't seen too much money go out yet, though, from the foreign side of the 8.5 billion. Do you think we could still be vulnerable to some more technical pressures, if some of that weightage?
I think if India actually continues to, if it does underperform, yes, I think then there's always pressure when you're over a market and underperforms, then there is a risk. But as I said, we are hoping that with the earnings revision starting to flatten out, yes, the budget, headline was good, but I think the composition with the expenditure increases was probably a little bit disappointing to some investors. But our view is actually, particularly within India, Indian tech, for example, looks interesting. As a house, we have actually put out a series of notes today to highlight Indian tech as a key buy sector.
Right. Is there any disenchantment about growth? That 4.5% has caused a lot of consternation back home, and this quarter may not be great either. Could that worry some of the people who loaded up on India over the last 6 to 9 months?
I think for India, yes, 4.5 is obviously a low number. But what we tend to look at more than GDP is actually earnings. And earnings revisions are actually starting to flatten out. So they're not rising, which obviously will be the best case scenario. But at least we are starting to see a slowing in the rate of earnings downgrade. If we add January and February together, the revisions are actually flat. Now, obviously, the upgrades have been driven largely by the tech sector, IT space, as you've had a weaker rupee, but also, we think business spending, corporate capex is starting to recover. So those are some of the things that we think will drive the market higher despite the weak headline GDP number.
Since you spoke about the rupee, is that something which keeps coming up in discussions because it takes away so much of gain from India for the foreign investor? Does the current account deficit, which is persistent, and the fact that the rupee keeps coming back to 55, is that a factor which might weigh against investments there?
I think the Indian rupee, you saw it, the day after the budget, right, when there was, I guess, disappointment maybe with the pace of consolidation. The concern is the current account resurfaces and the rupee started to kind of weaken. I think it also depends on how you position within India. So obviously IT is obviously a beneficiary of that. I'm not suggesting we only like IT, we also like other stocks that you've talked about, Tata Motors, Reliance Industries in the past. But we also believe that with the US corporate capex numbers starting to turn, so just in the last 1 week, we've had a 6.3% rise in US, what we call non-defense capital goods orders, one of the best leading indicators of corporate capex. Last Friday, we had the US ISM new orders numbers pick up quite strongly. We think these are all good indicators of a recovery in US corporate capex, and our view is Indian IT is probably the best way to play that.
Adequately captured in valuations because it's outperformed the market by quite a margin, or can you still buy names like TCS and HCL Tech?
As you know, I am very valuation driven, so I personally do struggle with TCS, which is trading at quite a big premium. So the stocks that I have added to the regional portfolio are actually HCL Tech and Wipro. And actually the premiums on those stocks are much more modest compared to TCS. And this is a feedback I'm getting a lot from clients today. As I call clients on the Indian IT call, hasn't the sector already outperformed? Yes, year to date it has, but last year, if you remember, it was actually one of the best performing sectors. So yes, on a 2-month frame, but as I said, I tend to take a longer time frame. So I'm quite happy to add, even though we've probably missed 2 months of outperformance, it was also, as I said, a major laggard last year.
And Wipro, you're sure the performance will turn around because valuations are compelling, but performance has not been up to the mark for the last many quarters.
Our analyst, Anand and Narayan, actually turned a bit more constructive on Wipro, even on the operational side, about 2 to 3 months ago. And on valuations, is trading like HCL Tech on a 20% premium to the region. I mean, to put it in perspective, TCS, which always delivers, is trading at 155% premium to the region. So to me, you get what you pay for. So to some extent, expectations in Wipro are quite low. Expectations, I would argue, in TCS are obviously quite elevated.
Right. Your big call at the start of the year was cyclicals. They started off well, but then in the correction of the last 4 weeks have got whacked quite a lot. Are you sure you want to hold on to that, given the nature of the volatility which has crept into the market?
Yeah, I think we're still keen on Tata Motors, Reliance, and as I said, I don't know whether you consider HCL Tech and Wipro cyclicals. So we're kind of still sticking to that strategy. I think, again, the reason the cyclicals have been whacked is, again, they performed very strongly, particularly in the second half of the year. So we actually are finding it that in the markets where cyclicals performed very strongly in the second half of the year, which was India and China, the cyclicals have actually been whacked this year. In Korea, for example, the cyclicals actually did poorly last year and actually are doing very strongly this year. So that's why I always kind of think there's always a price for everything. So if they run, I guess the lesson is we need to take profits and maybe not to chase the cyclicals if they run too hard. But certainly on dips like this, we would kind of continue to suggest buying the cyclicals. I mean, the risk obviously to the call, as we mentioned, is that India is a crowded trade. So whether additional money can come in, there's a further deterioration in the current account, which drives some of the concerns about the currency, the fiscal situation. But personally, for me, the biggest concern remains the fact that it's still, in our view, a rather crowded trade.
I've been speaking to some of the large country-dedicated funds. They don't seem to have got a lot of money. They say that it's the emerging market funds which upped India weightage through 2012. Do you think from where weightages stand today, there is a risk of a bit of skimming down given recent performance, or will that money not come off?
I think there's two types of money that appears to have come into India. One is sovereign money, is my understanding, and that's normally quite sticky. The other is the ETF money, which is the hot money. That's the money that can leave if India doesn't perform. So we are hoping that people can stomach 2 months of not performing, but as I said, hopefully we are right and India starts to perform. Even that hot money may choose to stay. So yes, I also do often get that complaint that the money has kind of gone into ETFs rather than into the funds. But normally when a cycle starts, initially the money tends to go into ETFs and then only later into the active funds. So we feel that maybe with a bit of time, even the active managers may receive more by the way of inflows.